Good morning. We're getting things wound down here. We're into week 10 or 11. What the heck does it say on D2L? Gotta have to keep track. Week 11. 5 weeks left. 2/3 of the way done. We're working on project 2. We're working on assignments. This week we have just the one assignment. Actually in a couple weeks here, you guys run out of assignments if I'm not mistaken. You just have some quizzes to work on. Look at that. Man, oh man. And so I won't have much to even talk about then, other than maybe going over a little bit on your projects. And that's partly why that's designed, but we get away from, when we get to those points, we actually get away from some of the quantitative stuff, and there's a few more other things. I'll talk a little bit about those other things. I'll probably get back to doing a little bit more of a normal lecture. In any event, for now we've got the quiz and assignment for chapters 11. And a little later I'll probably send out another video regarding project 2. So let's take a look at that 11. You guys have problems 2, 4, 6, 9, 11, 14, and 18. And so I did some kind of like it in some cases, I guess. And let's go take a look at them. You guys have 2. I did 1, except sorta. One's not really that way. I think I must have just made some up. Hopefully I didn't use the same amounts that you guys have. I didn't. So your guys' problem 2 says speedy delivery systems can buy a piece of equipment that is anticipated to provide an 11% return and can be financed at 6% with debt. So actually in this case we can forget about that return, other than as a comparison when we're done maybe. So I can finance, though, that with 6% debt. Okay. Later in the year, the firm turns down an opportunity to buy a new machine that would yield 9% return, but would cost 15% to finance through common equity. Assumed debt and common equity each represent 50% of the firm's capital structure. Compute the weighted average capital cost of capital, and which project should be accepted. Look at it in normal terms there, and you have a choice of two projects. One is earning 6% and one's earning 9%. Forget all the other stuff. Should you accept a project that has more of a return than another project? Okay, that's ultimately going to be your answer. Okay, and so what they're mistaken, and what the problem is trying to point out, is that they're mistaken in that attributing cost of capital to a project to maybe the specific source of financing there, as opposed to averaging it out. So we need to take a look at averaging it out. And I just used a couple different things. I said my debt cost of capital is 8%. My equity cost of capital is 13.5%. Debt's always cheaper than equity. Okay, I use the same weights, 50%. Okay, and so I just have to calculate then what my weighted costs are and add those up. So this is simply equal to my weight of 50% times my debt cost of capital. Okay, this looking at this by itself doesn't really mean anything until you add it up. It doesn't matter. This is equal to my weight times my cost. Okay, and then simply sum those two, right? And I get 10 3/4, right? And as you might expect, it's halfways between that. If I just averaged those, it would be halfways in between that. We do it this way because oftentimes our weights are not 50-50. I might have a 60% debt. Oops. And 40% that, right? Okay, and if I did, it'd be a little more difficult to calculate, and so that's kind of why we go through the calculations. At 50-50, you could average it, but obviously you can't in this case. So now when you look at, if you looked at a couple different projects, if I had your guys's are just 6 and 9. I wouldn't accept either one of those if this were the case, but if I looked at say the number 1, okay, and that's one has a return of 8 and one has a return of 14, right? The 8% one I'd decline. The 14% one would be the only one that would be acceptable, because you want to only choose projects that would have a weighted cost or a weighted return, I'm sorry, not a weighted return, a return that exceeds your weighted cost of capital, weighted average cost of capital. So only choose projects that have a return that exceeds your weighted average cost of capital. Okay, number 2, or I think you guys have 4 and 6, and I did 5, and 5 should get you there for both 4 and 6. I think one's a story problem and the other one's just like this. So for 5, it says just calculate the after-tax cost of debt under each of the following conditions. And what we want to understand here is that interest is tax deductible. Okay, it's oftentimes why I say debt's cheaper than equity, because interest is tax deductible. Equity costs are not tax deductible. Okay, and so it makes debt cheaper because you get to deduct that. And I'll show you an example over here. Let's go ahead and do that now. Let's say you had something that had a yield of 10% and a corporate tax rate of 25%. Okay, so I had a yield of 10% and a corporate tax rate of 25%. The effective yield, or the effective rate for me, my effective cost as a corporation, is actually only 7.5%. How do I calculate that? Well, I kind of set up a little deal over here to hopefully it demonstrates it. This is one of those concepts that once you get it, you really understand it, but sometimes explaining it seems to be a little bit difficult. So if I make $1,000, okay, in both these cases, and I'm going to have $100 worth of interest, but in one case I get to deduct the $100 from my taxes, in the other case I do not. Okay, and this is deduct, and this one is not. Okay, so I go through this and I do $1,000 and I $100 in interest. So my earnings before taxes, so this is EBIT, is earnings before interest and taxes. My earning before taxes is $900. My taxes then at 25% is based on this amount, based on the 900. Okay, so my taxes then are $225. Okay, and so my net income, just the 900 minus the 225, my net income is $675. Okay. On the other hand, if I do it this way, I make $1,000 and I don't have interest as a deduction. Okay, and so my earnings before taxes is $1,000. My taxes then are $250. My net income is $750. I still have to pay my interest though, so I'm paying it after taxes, and so I pay that $100 in interest, and boom, my tax, or my earnings after taxes, are only $650. Okay, and so I make more, right, because I got to deduct the $100 in interest, and I make an extra $25. Okay, or this deducts a full $100, right? This deducts only $75 from the $750 income, if you wanted to look at it like that. Okay, so hopefully that kind of shows you how to do that, or why we do this, and why it's deductible, or why it matters that it's deductible, I should say. Now my actual problem here is an 8%. Oops, let's go back and forget that. My actual product here was an 8% yield and a corporate tax rate of 18%. So we'll plug those back in. The formula here then is simply this. It's well, again, let's take a look. I'll plug it back in as 10% and a corporate tax rate of 25%. Okay, equals 7.5%. It's almost, it's really this minus this in essence. Okay, it's really this minus this in essence. How do we figure that here? We put it in this way. Okay, we go, this is equal to this one times, and I'm going to need a parentheses, 1 minus this one. Okay. There you go. Okay. It's equal to this minus, or I'm sorry, times 1 minus this one. Okay. Let's do that again. Equal this times parentheses 1 minus my corporate rate. The C rate stands for corporate rate. Okay. Once I get that, okay, you know, then it's simple. Again, I can just change these and it's going to automatically give me the correct numbers. And so this is my number 5. Well, guess what? Okay, I can plug in my other numbers for my problem: a yield of 12%, a corporate tax rate of 34%, a yield of 10.6, and a corporate tax rate. And my formula stays the same. I can just drag that down, right? And away we go. And you guys will be able to do that for number 6 as well. Okay, there we go. So you guys then jump to number 9. And I think I called it 8.5 because it's not actually 8, but it's not actually 9. I just changed the numbers. Okay. For you guys, it says Airborne Airlines has a $1,000 par value bond outstanding with 25 years to maturity. The bond carries an annual interest rate of $88, an interest payment, I'm sorry, of $88. That means that the original yield or payout was 8.8%, right? And it's currently selling for $950. So the price of the bond has gone down, so I know that rates have gone up. Airborne is in a 40% tax bracket. The firm wishes to know what the after-tax cost of a new bond issue is likely to be. The yield to maturity on the new issue will be the same as the yield to maturity on the old issue because the risk and maturity date are similar. Okay, but we have to figure out what our yield to maturity is first, right? Okay, and I did some different numbers. I did $1,000 par. I did an interest payment of $105, right? Okay, that's equivalent of a 10.5% rate, right? Initial rate. Your guys's was 88, and so your initial rate was 8.8%. I did a price for mine of $880. Okay, so again, the price has gone down, and so my yield, and that's what I'll discover, has actually gone up, and it should, right, above this 10.5%. And I did a 30-year maturity. You guys have a 25. I just wanted to do something a little different. So I have to calculate then, okay, what my yield is based on this information. Okay, and so here we go. I'm gonna solve for rate. Okay, I know it's 1199, so let's see if I can get this right. So I'm going to solve for rate. Okay, my number of periods is 30. My interest payment is going to be 105. Okay, and I want to put that in. Let's leave that as a positive number. Okay, my present value, what I'm going to pay for it, that's what's going to be leaving my pocket. After that, I'll get my interest payment, and I'll get this par value in the end as a future value, but my present value is what I'm going to be paying for. So I'm going to enter that in as a negative 880. And then my future value, I get that $1,000. Right? I'll get $1,000 when it matures. So they're going to pay me $105 per year, and then they're going to give me $1,000 at maturity. Okay, so that's where I get the 11.99, almost 12%. Okay, and in my case, I used a 30% tax bracket. Your guys' tax bracket was 40%. Okay, now because I'm lazy, I can come up and just copy and paste that down here, right? Ooh, did I do that right? I probably have more decimals is all. Is that what I came up with? We'll just, it's equal to, right, this one times parentheses 1 minus this one. And parentheses, and there we go. Yep, just more decimals is what I had up there. So, okay. Now we move on to, what do you guys have? 11, and so I did 10.5, which means it's just like 11. So Terrier Company is in a 40% tax bracket and has a bond outstanding that yields, is that right? Oh yeah, yep. That yields 10%. So what is Terrier's after-tax cost of debt? Okay, so in their case it's 10% is what you'd put in here, right? And their tax rate is 40%. Okay, and then you would calculate using the same formula you did up here, right? I'm just using different numbers, so I'm saying mine's 5% and a 42% tax bracket, right? Again, I can just copy and paste, okay? And I'm saying that the new, for you guys, it says assume the yield on the bonds goes down by 1 percentage point. So I took my yield down to 4%. And due to the tax reform, the corporate tax rate falls to 25%. What is Terrier's new after-tax cost of debt? So even though rates went down, so did taxes. Okay, those are actually both good things, but my after-tax cost of debt actually increased in my case. You guys may come up with the same answer, I don't know. Because the tax benefit that I get here isn't as great, right? And so it actually increases my after-tax cost of debt. So again, you guys may come up with something that's kind of similar. So okay, and then you guys have 14, and so I did a 14.5. I guess I should be coloring my answers here a little bit, but for 14, you guys have Wallace Container Company issued $100 par value preferred stock 12 years ago. The stock provided a 9% yield at the time of issue. That means it provided a $90, a $9, provided a $9 dividend, right? Okay. The preferred stock is now selling for $72. So the value or the price of the stock has gone down. So I know then that the yield that those investors are getting has actually gone up. What's the current yield or cost of the preferred stock? Disregard flotation costs. So here's the formula. What's my cost? Okay. In this case, it's K is equal to my dividend divided by my price minus my flotation cost, but I don't have any flotation cost, so I can take that out of the equation. It's just going to be the price or cost is equal to the dividend divided by the new price. Okay, that's probably actually, that formula is probably actually in there. Yeah, it's not. Right, so you can just take out the F though, because there is no flotation cost. So in my case, I did a par value of $200. I said that the original dividend was 7% or 14 bucks. Okay, and the original price, or not the original price, I'm sorry, the par price, the original price was $200. The current price is $176. So how do I calculate it? Well, it's simply equal to my dividend, which is 14. That dividend stays static. Right, that's based on the original par value and whatnot, but my price has gone down, so I would expect that the yield has gone up. Okay, if I were an investor and I only paid $176 for this preferred stock that has a $200 value, my yield would actually be close to 8% in that case. So, okay. 13 I had done, but you guys don't have one that's like 13, so let's just skip over that and get to 18. And 18 I kind of used a real world example. For you guys, it says this. It says business has been good for Keystone Control Systems as indicated by the 4-year growth in earnings per share. The earnings have grown from $1 to $1.63. Now I've got 5 years. Okay, I went back and I looked up Microsoft's earnings per share for the last 5 years, starting in 2010 and going through 2014. Actually, 15 I didn't include, and I didn't do that for a particular reason. They had an extraordinary item that cost them $10 billion. I think it was $10 billion. They had to write off. I think it was their investment in Nokia, maybe. that they purchased Nokia, and so they wrote off $10 billion associated with that. So that was kind of an extraordinary item, which would kind of skew my results. So I just went and I did 2010 to 2014. And in 2010, their earnings were per share were $2.13, and in 2014 it was $2.66. So you guys have, and you don't necessarily have the years, I just put them here, but you guys have an earnings per share of $1 up to $1 and the heck is it, $18.63. Okay, and you guys would just have 4 years instead of 5. Okay, I think for determine the compound annual growth rates, the first question. Okay. And you have enough information now to do that, and so let's go and calculate that if you'd like to. Delete this, and we'll just say, okay, we're solving for compound growth rate. Okay, so okay, number of periods, I got 5, but you guys will have 4, right? I don't have a payment, right? I don't have a payment. What I have in this case is a present value, or what the earnings per share were here, and I need to enter that in as a negative number. This isn't an in or out thing, really. This is just knowing how the formula works, and so I want the first one to be as a negative, and then the second one is what it grew to. Okay, there you go. Yep, so my growth rate's 4.54%. Now I use a lot of this. When I'm looking at investments, I'll look at a stock price, because you can do the same thing, right? If the stock price was $10 here and 5 years later it was at $16, what was the compounded annual growth rate? You'd use the same formula, and that's a nice thing to do, to be able to make some comparisons. Okay. Your question 2 then says, based on the growth rate determined in Part A, project earnings for next year, round 2 places to the right of the decimal point. So if my earnings were this last year and my growth rate is this, okay, I'm going to estimate my earnings for next year, and that's just simply going to be equal to my earnings last year times, okay, parentheses 1 plus my growth rate, okay, or 104.54. Okay, that should work. Yeah, 278. Yeah, and again, look at your numbers and just make sure they're rational, right? If this was 266 last year and it's growing at 4.5%, 278 for next year, does that sound right? Yeah, absolutely. Okay, so that's question B. Then question C says, assume the dividend payout ratio is 40%. Okay, compute D1. Okay, that means D1 is going to be what my projected dividend is. Okay, we're rounded 2 places to the right of the decimal point. Now I went back and I actually looked up Microsoft's payout ratio, which is 44.4%. Okay, so now I want to see what if this is my earnings per share estimate for next year, then if the payout ratio stays the same, this is simply equal to my earnings per share for next year times my payout ratio. 44.4% equals $1.23 is what I'm projecting my dividend to be then next year. Okay, the current price of the stock is $50. Using the growth rate G from Part A and D1 from Part C, there are questions A and C actually, compute KE. And KE, if you look back, towards the beginning or on page 361, KE is your cost of common equity. So what is your common equity costing you if you're calculating a cost of capital? Okay, if you're calculating a cost of capital, and this is kind of an important thing. But I went, and this was what Microsoft's price was a year ago. It's up to 50 something now, and that would again skew my results a little bit because I don't have 2015's earnings in here. So I went with the price that it was at that point in time. So here's my formula. Okay, my formula is that KE, or my cost, is equal to my dividend divided by the price plus the growth rate. Okay. Well, I got my formula there, so I should simply be able to say that my KE is equal to, I'm going to need a parentheses, my dividend divided by my price, okay, parentheses, plus my growth rate. So my cost of capital, or Microsoft's cost of capital, cost of equity back in 2014 would have been 7.4%. That sounds pretty reasonable, actually. Remember that Microsoft could borrow money at that time at close to 3%, right? Maybe even less. Kind of depends on how long they wanted to borrow it for, I guess. But you probably more compare this to long-term rates, which would have been about 3.5% for Microsoft. So their debt would have been a lot cheaper, and that debt at that point didn't include the weighted cost of debt with their the benefit of the income tax savings, and so their actual cost of debt would have been more like 2.5, right? So debt would have been a lot cheaper. Now, then it says here that okay, what if we wanted to calculate what their actual cost of capital was if they had to go out and raise some capital? Then I use this formula, and the reason I do is because ooh, what do you do there? I must have did something wrong. There we go. So in this case, it's just going to include a flotation cost, okay? And I use $3.75 for my flotation costs. So it's the dividend divided by the price minus the flotation cost plus the growth rate. Okay, so all I'm doing is I'm doing the same formula here, except in my denominator I'm subtracting the float cost from the price. Okay, and it should make it just a little bit higher, right? Because my denominator is going down a little bit. Okay, so equal to my dividend. Okay, and I'm going to need a parentheses. My dividend divided by, I'm going to need another parentheses, my price minus my flotation cost. Ooh, I don't have a flotation cost anywhere in there. I should have probably put that in there, but I'm going to use it's $3.75. I can just plug that into my formula. Parentheses. I got to have another parentheses to offset that parentheses, and then add in my growth rate of 4.54%. And voila, it is a little bit higher. That's to be expected, right? Because I'm taking the float costs out of the price of what I'm selling the stock for, okay? And so that would make my cost of capital a little bit higher. So there you have it. There's chapter 11, less than a half an hour. Not too bad. Thanks. Doggone, I keep getting a bigger number there, so. You guys have a good day, and again, I'll talk to you a little bit later about outlines for Project 2.